Episode 556, Trading Justice Podcast. Santa Claus in town? Maybe, right? Maybe. We're going to do our featured segment today on one of our favorite subjects, gold. My brother Matt has done a wonderful little presentation for us on the top 5 reasons to own gold. I'm not going to spoil it. We'll talk about that in a few minutes. We're going to talk about Santa Claus. We're going to talk about market conditions. We're going to talk a little bit about the history of what happens in similar market conditions over the last 60 years. A little study I did for our Hard 14 Mastermind group this week. Going to talk the Fed, going to talk inflation. We're going to break it all down for you as we head into, Matt, the end of 2023, right? This will be our last regular podcast we do. We will do some special podcasts we do at this time of year, predictions and awards and review and reveal the Tackle 25. But Matt, this is our last regular one for about a month.
It's always an enjoyable time when I get to see how many Bernankes versus Volkers we coaches at Tackle Trading get. I usually never win the Volkers and I never win the Bernankes because I'm not as radical as some of the others. So that's going to be fascinating. But those are some of the podcasts I really enjoy. I enjoy the review. I enjoy the predictions. I can't wait for the predictions. And then we typically end our year every year in the podcast with the conversation on the new edition of the Tackle 25. So next 3 podcasts, year in review, 2024 predictions, and then the Tackle 25. And then we'll get back to our regular programming in the Trading Justice Podcast where we dial in the market each and every week.
You know, it is a tough game trying to predict for the year ahead. But, really but wait for this transition, Matt. This is the best one I'll ever have. But the Tackle 25 has done a fantastic job of predicting the year ahead, outperforming the market 4 out of the last 5 years. Yes. We have a special webinar coming up on December 19th. It is a registration webinar. If you go to tackletrading.com, email me at team@tackletrading.
Right at the top of the website.
You can register for that webinar, but predictions are a hard game, and yet the Tackle 25 has beat the S&P 4 of the last 5 years. That's an impressive stat, Matt.
Yeah, it's, you know, we'll certainly take it 4 out of the last 5 years, and that's just on growth, right?
That's not even counting covered calls or anything you did, just flat
covered calls. It's just pure growth, and that's how we. You know, the covered call and everything else, that's the cherry on top. That's the cash flow. That's the compounding. But when you're looking at a grouping of stocks, 25 stocks, you got to compare it against something, and you're going to compare it against the S&P 500. And, you know, 4 out of the last 5 years, the Tackle 25, from a growth perspective, has outperformed the S&P 500. It's not going to perform. It's not going to beat the market this year because the Tackle 25 is not chock full of Mag 7.
Well, the Tackle 25 is not the Mag 7. Let's just call it what it is.
It's more RSP. It's a diversification. I like to put a lot of different sectors, representation of defensive, cyclical, aggressive. It's a diversified list. The better categorization in 23 would be the comparison to RSP, but all things weighted equal, you know that's how it is, and the Tackle 25 is an equal weighted. So when you're looking at the performance, yeah, it is impressive. 4 out of the last 5 years, it has outperformed the market. You add on the covered call and the compounding of the dividend, it's the metrics just get even more impressive. But one of the benefits of covered calls is smoothing out volatility over time. Whereas you can oftentimes get these whipsaws in the market, and we're going to talk about some of the V-shapes just here in a little bit. Well, when you do embrace covered calls and when you do embrace cash flow from a longer term perspective, it will smooth out that volatility journey. And I'm going to get into it in a lot of detail of why we do covered calls, what are the benefits of covered calls, how to apply covered calls, how to manage covered calls. I'm going to do that all in the Tackle 25 webinar. And for those pro members of Tackle Trading, I got a nice little present for you guys. We got a new system for the Tackle 25 coming. And anybody that has access to the existing Tackle 25 covered call system. We're just going to grandfather you guys in during that webinar. So definitely come to the webinar, register. You can hit it right there on the main page of the Tackle Trading website.
Yeah, no, it's register for that webinar. It is maybe the biggest free webinar we do of the year. It's a big one. And Matt, the last 3 weeks, listen, I'm just dropping transitions today, have been really good for covered calls and cash flow. It has been a good stretch for a cash flow trader. The markets have felt downright easy from a cash flow. Now, whenever markets feel easy, an experienced trader's like, okay, let's, how do you navigate now? But it's been a great stretch for the bulls period. The question always is, Matt, what comes next? And I want to start off talking about the unemployment report on Friday because, a big narrative guy, big thematic guy. And, we're in this little 5, 6, 7 trading day stretch where we have all of the major events for the rest of the year occurring. The first of which was the unemployment. And Matt, it is going to be really, really hard for recession is coming analyst to stoke up any followers when you have an unemployment rate dropping to 3.7%. I mean, it's just you're not going to create any narratives around that. The only narrative that's going to be created is that economy resilient, labor market resilient, right? Speak to that report because you and I, without talking, had the same thoughts on the matter.
Yeah, it's by far the number one economic report in terms of importance to the market participants and certainly to the central bank. When you're looking at those major economic reports right now, it's basically labor, slight inflation, and then everything else. But labor is just so far up on the importance scale versus everything else out there because the reality is, and I guess this is just how I kind of look at the totality of the economic environment, it has not been a great economic environment for the vast majority of people in America. But when you're looking at that ultimate conversation of will we or will we not trigger a recession, and what does that mean for the central bank moving forward, if you're anchoring against the labor market numbers, it's just really, really difficult to project a recession, specifically a deeper recession with labor that's under 4%. That's just not going to happen because 70% of the U.S. economy is consumer spending. 50% of that comes from American consumers. And there is still excess. The inflation we're dealing with is the excess money supply that has been in the market ever since the pandemic. And so you've had an excess of money supply. You still have an excess of money supply. That's why we're still dealing with 3% inflation, not the only causation for it, but certainly one of the major ones. And so when you're looking at that excess coming off and inflation coming down, the economic concerns for the future really do rely on whether or not labor gives up its strength. And Mark, for the last 18 months, ever since the Fed started doing their normalization of interest rates, and then as they started getting into a restrictive interest rate environment, you had economist after economist, Wall Street expert after Wall Street expert, Mike Wilson to throw out a name there, that was claiming that we're going to go through the biggest recession in the history of mankind. And it just has not manifested itself. We just have not even came close to that. In fact, the recession callouts for 2023, which were all over the place last year, they have been some of the worst projections in modern market history. And the reason that is the case is the strength of the labor market. And so until that labor market, and that's what I've been anchoring on for over a year now against with my opinion that we will not go through a recession, that will, if we do, it's a rolling recession, or don't get me wrong, it feels recession to everybody because of inflation, but that's not the definition of recession. And so in terms of that standard recession, it's just really, really difficult to see us getting into that as long as labor stays strong. And when you're looking at the labor market numbers right now, Mark, unemployment rate of 3.7%, that's damn near maximized unemployment, Mark. That is maximized labor. Anytime you're around 3.5% and 3.5 to 4%, the Fed is going to see that as the labor market is maxed. And so you have tremendous strength in the labor market, but it's not one of those Goldilocks situations where everything's firing off. You also have some flaws in the labor market right now. Job openings are starting to contract for the first time in quite some time. Job openings came out this week. It came in at 8.73 million. The expectation was 9.3. Mark, for the better part of the last year, we've been talking about job openings in the 9 to 10.5 million. This is one of the lower numbers we've seen in the year so far, and so that's a slight concern that we're looking at coming down the road.
When I put that together, they're not hiring, but they're not firing.
That's a good way to put it. That's a good way to put it, because we haven't seen massive layoffs, right? We got 3.
Yeah, I mean, you see, and if you, it's not even. Every once in a while, you'll see this bank is laying off someone, or Spotify was cutting back, but it has been isolated cases, certainly not
mass across industry or sector.
So they're not hiring, but they're not firing.
Yeah, and a lot of it was due to
with tight labor market conditions, that leads to low unemployment. Like
it does. You also had a miss on ADP non-farm last week, but in general, Mark, average hourly earnings was up 0.4%. Wages are coming up as inflation is coming down. I don't know how you could point to that as a negative. What's your thoughts there?
No, I mean, the wage number would be more concerning if
CPI was at 4%.
Exactly. Yeah. I was trying to figure out a way to phrase it.
If we were not on a trajectory to meet the Fed's stated goal of 2% by 25, which we are absolutely currently on from an inflationary perspective right now, average hourly earnings probably would have sent the market down. Would you agree? If we were in this inflationary environment.
But nobody believes the Fed is raising rates from here. Nobody. Like you and I were on this bandwagon a long time ago. Everybody is now, it is now consensus. You are going to have to see inflation dramatically pick up for that to even get in the conversation, let alone reality, which I don't think it would even in reality. But
well, and I mean, you look at the PPI report from last month, you look at some of the smaller metrics such as used car sales and so on and so forth. Even food-based prices are coming down. It's hard to see inflation don't get me wrong. A year from now, we might be having a vastly different conversation, but it's hard to see inflation double dipping and starting that trajectory back up in the current environment. Would you agree with that?
Yes, I do agree with that.
And that's kind of where we're at. So if inflation was concerning for the market, it's concerning for consumers, but if it was concerning for the market would not have went up on a day where you had average hourly earnings go up against the expectation. Because how many times have we seen average hourly earnings this year, Mark? How many times have we seen average hourly earnings go up and the market tick down?
Yeah, no, I can go back to 2018 in February. It was one of the bigger crashes we've had. The average hourly earnings can impact the market dramatically. No effect, zero effect on Friday. So Matt, this and you have been very steadfast on if the labor market's strong, the recessionary,
I'm sorry, people have a job, they're going to spend money, and if they spend money, the market we won't go into a recession.
And if you don't have those recessionary fears, the market's going to trade on other things, right? It's going to trade on other things, and those other things still generally positive, right? It's really tough for bears to gain any traction, especially in upward momentum conditions like the market's been experienced, unless they got something to stoke the fire, right? Unless they got something. And slowing.
There's a lot of uncertainty in our market, right?
Yes.
We're specifically talking about labor, but there is uncertainty and there is variables that could manifest themselves this week that the market doesn't like, right? But from a labor perspective, from a recessionary perspective, that labor market number was the most important number that we were going to get throughout the end of the year, and the market went up based on that number. And so you got to be looking at this as a bullish environment with the potential of a breakout this week, especially with what's on the docket this week. You got a tremendous amount of economic reports this week.
Yeah, I was going to say, what is on the docket this week?
When you're looking at this week, last week was all about labor. It was just labor, 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 labor. And if you'll recall, Mark, 2 weeks ago when we were in the podcast, I said, if we got 2 weeks of consolidation and then broke out on labor market, that would be pretty much the Goldilocks technical situation. And that's what we're starting to see. If that breakout that we saw get above 4,600 on Friday, if that has any legs, and if Santa Claus is going to come to town here in the next few weeks, it's going to be backed on some of the variables that are happening in the market this week, because we have an absolute stacked deck this week. Don't get me wrong, labor's number one, but when you get into the Fed, CPI, PPI, everything, core retail sales, industrial manufacturing data, you have it all this week. CPI on Tuesday, PPI on Wednesday, Fed funds on Wednesday, core retail sales on Friday, and the manufacturing indexes on Friday. And so you got a tremendous amount of information coming into the market this week. I do feel it's going to be a choppy market this week, given the fact that you have a lot of variables. Algorithms live in those variables. And so you can expect a little bit of a dose of volatility this week. But I also think it's this week that really sets the stage for the last 2 weeks of the year, which is when you start getting into the Santa Claus conversation. When you're looking at, for example, when we're looking at next week, the week after next, it's not that final GDP is not important. It's just not important to the market, given the fact that we've had the advanced and the preliminary GDP number. And quite frankly, the third GDP number it should not be colored red. Neither should the second one, because the Atlanta Now GDP is far more important to the market in those instant updates than what we're looking at what the third quarter GDP was last quarter. Yeah, it was 5%, whether it's 5.2, 5.1, 4.9, that's a good number. The Atlanta Now GDP is currently at 1.2% for the fourth quarter. That's a more accurate number. That's the important number for the market. This final one's not that important. Core PCE and price index is the third most important. I'd actually put it as the fourth to the market when you're talking about average hourly earnings in the labor market numbers. But for the central bank, it is the preferred gauge. But I doubt we're going to get a different read on PCE that we get on PPI and the CPI report. Then you get into Santa Claus week, and Santa Claus week has nothing. This is nothing. Low volume, people go on vacation, and then you're done. So when you're looking at the landscape coming up, if we're going to get that Santa rally, it's going to be backed on the variables that are coming to the market this week. And the way I would rank those variables this week is I would rank them as CPI 1, because it's 1 day in front of the central bank. It's the one variable that could change the central bank. Do I think it's going to change anything that the bank comes out with on Wednesday? Absolutely, I do not. But it is a variable that you have to take into account. PPI report, there's been no flaws in the PPI report. I doubt we're going to see a flaw in the PPI report, but we'll wait to see that on Wednesday. And then and so the Fed on Wednesday would be the second most important report this week. The Fed is not expected to do anything, but this report on Wednesday with the Fed is going to be important, because it's Jay Powell's last moment to give a press conference, to lay out what is going on this year, and to give a vision for next year as well. And in the past, this mid-December monetary statement has given the market a lot of price action in the past. So I do think you got to be aware of that one coming on the 13th. And then after that, I think we're just going to see secondary reactions following the Fed on Wednesday with retail sales and the manufacturing data that comes on Friday.
Yeah, no, man. And I did a study this week, and I'm a contrarian by heart, right? I always have to give this preface. I'm always looking for reasons to fade things or how to position. And I use history as a really big guide. And man, I went back over the last 60 years and examined how is price performance after these V-shaped rallies in similar conditions, right? So we've had a powerful V, right? And it's very easy. In fact, you and I have had conversations with traders who have said this market has gone up too much. I got this all blah, 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 right? Typical, like, it's gone up too much argument.
The market always goes up too much or down too much. This is what we deal with in the market. This is not the market going up too much more than you expect and down more than you expect is not something that's going to dissipate in the future with algorithms. It's the Mountain Dew markets for a reason.
Mountain Dew markets, things are extreme. And, I went back over the last 60 years, Matt, and been like, all right, and what happens after the V? Now, we're not even done with the V yet. Let's get this prefaced. I use on as the base for my study. I
was going to ask that. What was the base for how you consider
SPX? And so the V ends on the SPX when you close below the 9 EMA on the daily chart, and then you get a additional downward 10% ATR movement. So the
closing candle on Wednesday that closed underneath the 9, but just by a hair would not fit your study.
No, I just need a smidge of additional downward movement on the next candle, right?
You're trying to get away from just some volatile
one day event.
Yes. Okay.
And so we're still in my study. We have now been above the 9 for 27 straight days in my study. So we're not even done with the V yet. Matt, the longest V I have on record is 42 days. I have several in the 30s. And so, one of the things, because I did a similar study about 5 weeks ago for my Hard 14 class, and I'm like, don't underestimate how long a V can go. When you are coming off extreme selling conditions, once momentum takes hold, it can last a while. And I remember when I brought up that general concept to you, the first thing out of your mouth was, yeah, because they're usually associated with some catalyst.
It's a catalyst-driven move.
Like, so extreme selling, and the catalyst this time was easy to identify. The Fed
confirmation of pause.
The Fed confirmed a pause.
And the market took that as we're going back down to zero. But yeah, it was a legitimate catalyst that the Fed provided the market 6 weeks ago.
So we are 27-day trading days, not calendar days, trading days above the 9 EMA on the daily chart still. So it still has life, but it's going to end eventually, right?
Still a ridiculous run, 27
Still, days. 27, even if, whether it goes to 35 or 41 or 29, right? It's been a great run.
What was that oil run we caught?
Oh, it was 40. It was 40.
Was it 40 days? It was 40 days, wasn't it?
It's the thing to understand about things that come off selling conditions when they get going in these markets. How you participate is one thing. Don't try to fade too early. Don't.
Can we talk about that before we get into some of your detail? Just
yeah, absolutely.
I think this is a starting point of a bull market long term. I'm not
the phrase
sure.
I like to use, Matt, is this the start of the next great bull market?
Well, historically, I think we'll look all the way down to the 3,600 bounce from earlier this year, because I don't think we'll go back down to that level. But which means this is already.
I'll do apologies to Jeremy Grantham. The Fed will inject liquidity into the system and panic before that happens again.
I agree with that. 1,000%. But there's obviously chop in front of us, and next year is going to be a year we're going to have to navigate as well. But in this current momentum environment, you never question the momentum. You have to allow momentum to play out in the marketplace. And when you're talking about that study of the 9 mark, you're never going to question the market until the market gives you a reason to question it. But the one thing I will say is, because of the V, because of the parabolic nature of the market, when we do get reversal patterns here, there is going to be really good shorting opportunities.
Amazing shorting opportunities.
Maybe
not even the market itself, but Matt, meme stocks have went
individual plays. Yeah.
Parabolic lately, right? Like they're setting up for
the market in the last 6 weeks has partied like it's 99. It has. And so, yes, there's going to be some ridiculously good shorting opportunities in my estimation. I'm just not sure I'm in the mode of looking for those great, amazing.
Yeah, and that's why I wanted to do the study, Matt. What does history tell me?
Yeah. So let's go back and let's take a look at them a little bit. How many examples of V shapes did you recognize over the last 60 years?
24 are in the case study.
24 in the case study. Okay.
And you want me to dig up a couple dates for you? Oh my goodness, I wasn't.
No, you don't have to do the dates because there's a lot of different examples, and we're not going to point to them. I'm just looking at general stats here, Chucky.
Yeah. Well, the first principle was don't underestimate how far this can go, right? Don't underestimate how far this can go because it can go for a while. We're on day 27. We have examples up on 42 days, in the 30 days, and so forth. But, along everything you were saying, I mean, it's what triggered my interest. What happens next? Should I get ready to aggressively short, right? Should I prepare? Where should I be preparing? What's the next, thing? I wanted to know what price action looked like after the V. And 24 case studies, Matt, 40. And so I examined what happened in the month after the V broke. It's not even broke yet, right? We haven't even closed with confirmation on the SPX on the daily chart.
We're talking about a multiple time frame breakout right now on every single time frame.
And I looked what happened the next month, what happened month 2, and what happened month 3.
Okay.
And I took just the long duration.
These are after month 1, 2, and 3.
After the V
ends.
After the V's broke. After you've already
closed underneath the 9 on the daily with did you say it was 1 ATR?
10% of an ATR. I only need a smidge.
1 ATR. Okay, you were real tight against that. Okay.
And then I took the long duration, these that lasted over 20 days. Right? Because I wanted, we're day 27. I wanted a comparison to.
You wanted to see major moves.
And I had 14 case studies in that. So 14 times in the last 60 years, we've come off a V off extreme selling pressure that's lasted over 20 days above the 9, sometimes in the 30s, sometimes in the 40s. And then I looked at the price performance the next month, month 2, and month 3. So I wanted a playbook for 3 months, right? Matt, that's 42 months. When you take the 14 times 3, 41 of the 42 months were cash flow friendly for bulls.
So neutral to bullish.
Neutral to bullish. 41 out of 42. Doesn't mean you don't sell off for a few days here and there.
Oh, that's just pattern identification.
But the bearish conditions that make great shorting opportunities that are broad are really hard to non-existence to find over the last 60 years from a bearish condition. Now, it doesn't mean you keep extending, because remember, in a V, you've already made a huge, massive jump. But in the latter part of month 2 and in month 3, that is when you see a lot of great directional next to it becomes more directionally bullish as well. It basically said very friendly.
Don't fade is what.
Don't fade this too early, other than maybe some token bearish low delta theta, right? Like, but buy the dip if they were to occur, but don't fade it too early. And I was like, oh, well, I won't be doing very many bearish trades the rest of 2023 after I did that study, because, man, I want to fade. I want to be the contrary. I enjoy it. But, man, I can't ignore 41 out of 42 on a case study, right? That's an overwhelming stat that spreads market participants over 60 years, different market conditions, different this, different that, right?
And before anybody's like, well, this time's different.
Yeah,
No,
I don't bet. I don't. If you're a bull, if you're a bear, you don't bet this time is different because guess what? It normally isn't.
yeah, and this time, the reference to this time is this time's different because
Because the price is just going to collapse because this is going to happen and you're going to be down to 42.50.
Has happened before, will happen again, rinse and repeat. It's not different. Mark, that's a compelling data set for bullish analysis, quite frankly. And I know you see it from a bullish cash flow perspective, because that's primarily what you seek to do in the market, is to create cash flow. But from a directional perspective, Mark, when I just look at this environment from a technical perspective, kind of adding on to that bullish analysis, again, it's a neutral to bullish case study. Is that consider it
over the next 3 months? And Matt, that puts you through mid-March. If the 9 broke this week.
Yeah, it's a good neutral to bullish situation. I want to take it from a technical perspective, Chucky, because that's good background for what I'm going to talk about here. Technically here, one thing that I always think is really, really important when you're dealing with the market is the concept of multiple time frame analysis. Oftentimes, when we get so fixated on the daily chart, we just look at the momentum of the daily chart. We look at it from a overextended situation, from a breakout, from a retracement, from a candlestick perspective. But oftentimes when all you do is look at the daily chart, what's the old saying, Mark? What is that? You missed the forest through the trees?
Mm-hmm.
Okay. You don't see the landscape of what is actually transpiring here. And so multiple time frame analysis, what we call the MTF trader at Tackle Trading, takes into account not just the daily chart.
It's so important.
But the weekly chart, the monthly chart, intraday analysis to get the full backdrop, the full picture of what is happening from a price action.
And I just got to interject, multiple time frame analysis. Like I was on the lounge this week and we were analyzing Google, and one of the guy that comes to the lounge regularly, who's not a trader, he's an investor, comes to the lounge, he's an investor. And I know I've answered 100 questions from him before. Yep. He's like, Google, would you sell a naked put? And Google was down and the chart was ugly on the daily chart. I was like, well, let's go look at the weekly and monthly chart. We looked at the monthly chart on Google. We're like, that thing's beautiful.
It's
that thing looks beautiful. Like, yeah, so I would sell a naked put as an investor today, right? And
but if you just looked at the daily chart,
I would have been no.
Like, no, you gotta let that play out. You gotta wait for a better
multiple time frame analysis can help you no matter what type of trading.
Especially when you're dealing with those levels in the market that are catalyst driven levels, that are rock solid, that everybody's looking at. Sometimes as a technician, Mark, I feel like, I'm looking at a level and it's just me looking at that level. When you're talking about these multiple time frame analysis, it's not just you looking at the level, it's everybody looking at the level. It's Wall Street, Main Street, algorithms, central banks, you name it, everybody's looking at the level. When you can go into CNBC and they're talking about a number in the market, I promise you that number is looked upon by every single trader in the entire marketplace. And so 4,600 is one of those levels. Not only is it a previous pivot point, when you look at the daily chart, you got a beautiful pivot at 4,600. It's where all of the consolidation is going on in the market right now. It's right underneath that 4,600. When you do, and if you have an opportunity, if you're listening to this podcast and you want to go out and do some studies on your own, just go pull up the S&P 500 and look at it from a daily, weekly, monthly time frame. When you look at the weekly time frame, you see that 4,600 zone and you're just like, okay, this is a intermediate to major pivot 3 different times in the last 2 years. Two of those times, the previous 3 times the market came into 4,600, it got double whacked with a couple weeks above there at the beginning of 22. And then you basically had at the top end of the channel in the summer, that's where the pivot was as well. And you're right there as of right now as well. And so you got this pivot point on the daily, you got this pivot point on the weekly, you come out to the monthly time frame, you're going to see the exact same thing. And so when we're looking at this potential breakout of 4,600, It's a breakout on dailies, weeklies, and monthly timeframes. And after the consolidation that we did get in the S&P 500 over the course of the last 2 weeks, up until we saw the labor market numbers, it was a real good consolidation, Mark, without a lot of weakness to it. Like you were talking about, it didn't even breach the 90 EMA outside of one day that just closed underneath it a hair. It recovered right back up on the labor market news on Friday. And so, yeah, you're talking about a potential breakout. And last week when we were staring down the barrel at the breakout of 4,600, I didn't love it, Mark. I just didn't. I didn't love it because when you were watching the price action on Friday of last week, not on labor market news, when you were looking at that price action on Friday a week ago, it was all at the close based on an algorithm move that was based on hypothetical situations that may or may not occur in the next week. It was not something I loved. It wasn't coming from a catalyst. And you also were in front of the labor market news. Now you're talking about a potential breakout post labor market news with a little bit of a better consolidation situation. And so I do think, and again, we're not raging bullish at tackle trading. I believe our rankings at tackle right now in the S&P are about a positive 30, maybe a positive 25. But it's in that, slightly bullish ranking at tackle. You break out here, you would probably upgrade that just 5 points. And so we're not screaming bullish, but when you're talking about a really pristine, clean technical breakout on a multiple time frame perspective, we're going to geek out on that opportunity because this is where you could see momentum start to play out. And yes, you got a tremendous amount of catalysts this week, i.e. variables this week, that will provide that volatility to the market. And some of that's going to be up and some of that's going to be down. But in general, technically, the market does support a slightly bullish ranking. And when you're looking at where this market can go, Chucky, who knows about Santa Claus in a week and a half from now when we start getting into that conversation. But you got a little bit of room between 4,600 and you start getting up into those all-time highs on the S&P 500. And Mark, if we get a little bit of momentum here, I would not be surprised to see 47, 4,800 by the end of the year, just from a pure momentum perspective. I don't think the fundamentals would support that type of move, but I'm not going to be the dude that's going to question the momentum condition of the market. I want to see this play out, and the bulls are playing with a little bit of casinos cash here, Mark, so I think they're going to be pushing it a little bit going into this week, especially with the Fed on deck on Wednesday.
Yeah, no, absolutely. It's all about tactics right now. It's all about trying to maximize, because that's what we're trying to do. Like a lot of people have had decent years, right? I mean, it's been a decent year for me. It's been a decent year for a lot of traders.
Mark's at all-time highs.
And
not all-time highs, but in general, you get my point.
Yes, and so you're just trying to make good decisions, and I know conservative cash flow from market analysis on the narrative standpoint for me, or even aggressive cash flow. I know from a historical standpoint, I know from a seasonality standpoint.
Can I make up a fake confidence ranking scale here?
Yeah.
Your confidence scale on neutral to bullish cash flow plays right now. Naked puts, covered calls, bull put spreads, horizontal calendar spreads, anything on the theta side of the equation that's neutral to bullish, rank it 0 to 10. 0, you have zero confidence. It's too volatile of an environment. 10 is the greatest cash flow environment in the history of mankind. How would you rank yourself?
On pullbacks, if we were to get one, it's a 9 out of a 10.
The dip mentality is just strong.
It is a 9 out of a 10, and the only reason it's not a 10 is that you have to have special conditions to get a 10, right? But if you get pullbacks, orderly pullbacks of any kind, if you stay neutral here with any given moment, it's an 8 out of a 10. I mean, and the only reason is a step down is because you still have the bulls are getting a little froggy in certain areas of the market.
Confident. Yeah.
On upward movement, it would drop just because bulls will get insane and do stupid stuff. And plus I'll have to choose higher strike prices. but I'd still put that in the general 6 range. My confidence on bearish cash flow is a 2.5, and that's on conservative. I haven't seen anything on a shifting volatility.
I'll tell you, we were putting the options report together, and we were thinking, hey, can we? Because the bear directional plays, they're just they're not extinct any longer, but they're not there yet.
You and I had a conversation with a trader 9 days ago on a Friday, and you and I were talking to them, and they're like, "Oh, this is market, blah blah," just giving the typical bearish, not. And you and I came back and said the charts are too orderly right now. They're and not just
consistent.
They're like the charts are too orderly, not just here and not just there. Everywhere. Bottom of the chart, orderly.
Top tier.
Mid of the tier, orderly. Top tier, or I gotta see something break. I gotta see meme stocks crash. I gotta see the ARK crash. I gotta see I gotta see something.
Don't you gotta start seeing a violation of even short-term support to before we start getting a little bit.
I just gotta see one area of the market start showing shifting volatility, and then I can extrapolate that. But I don't even see that.
Not yet. You really haven't. Gold certainly has that. We'll get into the gold conversation here in a minute. But in general, the broad market, and again, we're talking short term, not long term here. But in general, the way I would answer that is from a directional perspective. I think you would categorize your confidence ranking as a 6 out of 10 on the directional side of the equation. You have an edge, you take the edge. That's kind of how you see this market environment. There's a lot of really good technical setups on the bull side of the equation, but in the back of your head, why it's not a 7 or an 8 or a 9 right now, despite the multiple time frame perspective, is we're still talking about some very difficult economic conversations that we're going to be having. You have a lot of variables this week specifically. For example, if we were looking at this exact same thing, multiple time frame breakout after all the data that's coming into the market this week, I'd probably be a 7 going into the last 2 weeks where you don't have a lot of economic variables that would drive the market one way or the other. So I would rank it as a 6 right now. Any deep pullback, you'd have to go through pattern development. I would not like a deep pullback from a directional perspective. You don't want the market to give up its momentum edge in these high base environments. For example, I think back to the 2013 markets.
Directional traders do not want to see deeper pullbacks.
No. That is not what we want.
It's too easy right now. And you don't want to get, I love how you phrase that. You don't think about
a deep pullback here would dirty up every single bullish chart out there, and it would create massive overhead.
And the second things get dirty, that will give bears maybe a little more oomph, and bulls a little more hesitant. It changes everything.
It does, but that's not what we have right now. So if we did see that, I would rank it as a 6. Mark, I think 4,600 here plays. It would not surprise me to see a breakout and get a little bit of legs this week. But again, there's a lot of variables. I think you're going to be a little bit cautious this week just because of the variables, but you're still a 6, bro. When you're talking about this environment as a directional guy, a 6 is a pretty high ranking right now, quite frankly.
All right, I want to talk about 2 other areas of the market briefly before let's talk bonds real quick, and then we're going to talk oil, and then we're going to get into gold. All right, so narratives, right? This has been a great run for bonds. It's been to get a healthy stretch in bonds, just like it has for equities. I have a hard time wanting to not take profit trim bonds after the labor market on Friday, because once again, there's 2 aspects of the equation, and bonds has to deal with both of them. Equities only has to deal with one of them, sometimes deal with both of them. Is one thing that we're never raising interest rates again. It's another thing how fast cuts may occur to the market. And bonds has to deal with both of those all of the time. And Fed's not raising again, right? If yields were to rip and bonds dip, buy the dip. But if unemployment is at 3.7%, put me down for a no hike in March, Matt. I mean, no cut in March camp. which had been priced at about 60% that, yes, we were in March. Bill Ackman had came out. That got trimmed.
It came down after labor.
It came down after labor, and it's really hard to see cuts that early if the labor market is strong, right? It seems too soon.
It does seem too soon. Let me take this twofold. The first thing I would say to the bond conversation is we've already priced in expected cuts for next year.
A lot.
So anything that we're seeing on this chart on March, the expectations in May, the expectations in June, all the way out to next September, where you have basically half of the market between 75 basis point cuts and a full point basis cut by all the way September next year. Mark, that brings down that interest rate to about 4.25 to 4.5. We'll just call it midpoint 4.5. And so that has been priced in to the marketplace. That's why TNX has came down, is because we have priced that in. And so,
and it's that simple.
And so I guess my question would be, after it gets priced in, do you want to come in and be the buyer after all of that has already been priced in? Because if you're going to be the buyer here of bonds, you got to be expecting that the Fed's going to cut more.
You have to be in the recession is coming and coming soon camp.
Because Mark, where the interest rates are right now, they're not projecting a recession where the interest rates are right now. In terms of the projections, they're projecting a soft economic landing, inflation coming down,
and allowing the Fed to cut.
Allowing the Fed to cut to bring it out of restrictive territory. And so they wouldn't be restrictive and they wouldn't be as supportive. They would just be net neutral on the interest rate front in that environment. And so if you're going to continue to see bonds coming down from here, it's got to be on the backs of something that we are not familiar with as of right now. And that has to be, you think a recession is coming faster or more difficult recession than what the market is expecting right now. The market is not expecting a recession right now. The market is expecting a soft economic landing. Why are we talking about yields coming down while the market's damn near an all-time high right now? That's the soft economic landing being played out. And so a little bit of mission accomplished, premature wise out of the central bank, but I just don't see that. And so to me, to answer the question, I think if you're already involved in bonds, yeah, you got some good price action. You got a good price. There's nothing wrong in the analysis. But if you're looking to add on to that right now, I'd be a little hesitant. Personally.
It's not the right time.
I'd be a little hesitant. Number one, I think you've already priced in aggressive cuts that are not guaranteed next year. We are not guaranteed to cut next year. Is it likely? Yeah, I do. I'm on that page too. But would you say it's a guarantee the Fed's going to cut next year?
Absolutely not.
No, it's not a guarantee. And yet we have priced in a guarantee of the Fed cutting interest rates next year. And so is that the most likely scenario? Yes, but you got to expect something more than that. And Mark, there's a chart here on the TNX that I can't stop looking at. And it's the 90 MA on the monthly chart on TNX. I've been staring at it for the last week and I'm just like, yeah, we priced in this, but what else are you trying to get here? And so I'm with you there. I think it's a time to be a little bit cautious on the bond side of the equation.
Yeah, I would, and on that narrative standpoint, Matt, give me crude oil. I'm sorry. I'm starting to get feisty. I'm starting to get, listen.
You've already sold naked puts.
Oh, I already own it. I'm going to add some more this week, from that.
Oh, that's right. You didn't even do the naked put.
No, I'm adding. I'm adding.
Okay. I got to tell a story real quick. So on Friday, me, Gino, Mark, Frank, Greg, we're all kind of hanging out at the Scatter Report meeting. And before we get going in and curating our watch list and ranking all the different areas of the market, we're just talking shop. What are you
talking do? Shop, talking charts, talking.
We're talking oil, and all of us think oil got priced in a little too aggressively here. Would you agree with that?
Yeah. Yes.
Okay. in general, I think the synopsis was we feel oil was pricing in a recession, and the recession data didn't come in to support it. I see it a little bit like that, but I also love kind of the support levels you're coming into. That 200 weekly moving average, I think, is extremely compelling. And I asked Gino a question. I said, "Hey, Gino, what are you doing here? What's your thoughts?" Because me and Frank, we're going to wait for a nice little short-term reversal here. Either whether it's V-shape, W, head and shoulders formation, I don't know, but that's what we're going to wait on. You and Gino and Greg you're a little bit more of the aggressive cash flow.
We'll go contrarian. We'll go certainly from a cash flow perspective against trend. Yes.
And I'm asking Gino, what are you doing with crude? And he's like, I'm just kind of waiting on this little pivot and letting it play out a little bit, right? You're dealing with the bearish downtrend, pretty standard response, whether you're a directional or a data trader. I asked Greg, same type of conversation. Asked Frank. Frank's like, no, I love the pivot, but you got to see more.
Frank ain't never buying that chart in a million years, no matter what the ticker symbol is.
No, I would do it before Frank would. Frank, there's not a chance.
And you wouldn't do it, which lets you know. Yeah.
I wouldn't do it. Are you kidding me? It's a bearish downtrend with momentum, and you haven't even breached the 90 MA. What are we talking about? No, of course not. But then I go to you, and I'm like, hey, Mark. Oh, wait, I kid. Gino, Mark's probably already selling naked puts. And you say to me, what are you talking about? I just bought shares. And I'm like, okay, Mark, that told me something a little bit different than your standard response, because you're very quick to sell a naked put on an overextended situation on an asset class that you
pick up some lunch money, pick up a couple bucks,
You are not very quick to add shares in that environment. That is abnormal for you, my friend. Can you talk to me about what you were seeing and why you're going against the grain here, Mark? Because
I'm totally going
against the market here.
And I am starting to run my mouth on the subject.
You're getting mouthy. You're getting cocky.
I'm getting mouthy. Okay, first of all,
don't get cocky. Don't get cocky.
No. Listen, I'm up to 4% of my portfolio in oil. That gives me plenty of room to navigate, right? Yeah. I'm willing to go about to 6%, 6.5%.
Reference, your gold ownership is what right now? 15?
No, I trimmed gold a little on Friday.
Oh yeah, you rotated into GDX a little bit. That's right.
But gold's higher. All right.
My point was you have room to add here.
Oh yes. But that's still downtrend. That's a pretty hefty amount for me to be building into.
Yeah.
Here's my case.
Like I got zero oil right now.
Yeah. Here's my case on buying oil here. I think I got 5 major points. One, whenever a commodity clips 30% in a time period, you should look, right? That doesn't mean add, but you should look, right? That generally over history is not a bad idea, but it goes far deeper than just contrarian by the deeper dip analysis. One, there is such a massive disconnect between crude oil and other cyclical products, whether it's copper or cyclical equities or whatever. The disconnect is large.
Fascinating.
I mean, it's not just a little bitty disconnect. It's not like, oh, cyclical stocks have outperformed by 4%, or copper. No, you've got a massive wide gap where one has
industrial finance have been absolutely fantastic, and energy has been absolutely terrible. And that is energy will move on its own, but not like that. And not on a pivot where everything is participating identically, and yet crude energy completely separating from correlation against any cyclical area of the market.
Yeah. And so there's that general, and once again, that's a great reason to look whenever you see something that doesn't make sense from a narrative point. Yeah. So those are a couple reasons, but the other goes three. The other reasons are more core for me, and maybe even 4 reasons. One, the narrative on Friday, everything we've talked about in this podcast, right? Recession, like what do you think sends crude oil down here from the demand side of the equation? It would have to be pricing in a recession. One could argue that has been occurring. After that unemployment number on Friday, you're not going to get any more recessionary talk the rest of the year. I mean, that's,
You're going to get it because that's
but yes, but as far as it,
whether it's manifest itself in the market's a different conversation.
You know, and so like just the economic narrative is detached from the oil chart. You have the most shorting in crude oil right now since 2020, pandemic, all of that. When you get extreme shorting, we'll just ask bears how that felt for equities 6 weeks ago. Go ask gold shorts how that felt, right? And so you have when you have that much shorting, it sets the stage for something potentially explosive. I'm a firm believer in Saudi Arabia has your back on oil trades, right? Now,
Saudi doesn't want to see a violation here.
And yes, has there been all kinds of shenanigans going on in the oil market? Sure, you don't have the disconnect with other cyclicals if there's not, right? Shorting this, that. Was Saudi Arabia good in their messaging in their OPEC meeting a week ago? No, they were terrible.
They were horrible, Mark.
Right? They were terrible.
But OPEC and Saudi has had in a long, long time. I hated the messaging. I said it last week in the pod. I said it that day in the halftime report. Everybody's talking about, oh, the OPEC's cutting, OPEC's cutting, OPEC's cutting. And I'm like, no, they're not. They basically said, we're going to give every OPEC nation the opportunity to cut if they want, and we're going to just trust them. And I'm sorry, you don't trust OPEC nations to cut if they're not contractually required to cut with an enforcement clause on top of that. And so, no, that was Saud basically admitting that they did not convince the other OPEC members to agree to non-voluntary cuts. And so I hated the messaging coming out of Saudi Arabia.
It was terrible, but one cannot mistake their commitment here, right? One factor in that, like Saudi Arabia, their commitment here on the supply side is strong. You might not need their commitment if economic data picks up at all. And then the final wild card, I think I've given you 6. 7 is China. You cannot do any commodity analysis with knowing what the big bear's doing over there, right? You know, what track are they on? I mean, they're freaking buying ETFs now in the market. If you don't think they are doing everything in their power to stimulate, right? Now, has this helped iron ore? Yeah. Once again, cyclical product, iron ore. Totally on China economic action. Iron ore's had a great 5-6 weeks. Copper, stable. Iron ore, up. But crude oil, I think has 7 reasons. But when you put all of these together, and once again, if you take this, throw in technicals, right? You're the 200 weekly freak. You take any one of these reasons, I can start building a case. When you give all 7 of them, I'm like, I'll freaking just add, Mark, and figure out the rest later, right? That's just basically where I'm at right now.
You think there's a pivot point here. You think there's a reversal, and you know me, I'm always going to wait on reversal analysis. I love reversal analysis too much. I love the technical conversation in conjunction with the behavioral analysis and reversal analysis. And I think you can get very similar price points with a higher probability, but the risk is V-shape, Mountain Dew market, everything leaves you behind, right? That's the risk there in that type of analysis.
And especially, and once again, catalysts. Remember, catalysts are important. And Friday's unemployment report was one of those, oh, yeah, that recession ain't coming anytime soon. It was one of those just moments where I'm like, yeah, I got to start running my mouth on this, because in Mountain Dew markets and extreme shorting, it don't take much of a spark. Right. It don't take much of a spark. And so, yeah, right. You know, cash flow, I'll add some. If I'm early, I'm early.
I loved all your reasons. I thought all of them are legitimate reasons. It's why we're talking oil. It's why we're looking at oil. I'll just say for me, it's really simple. I feel like we were pricing in a recession in oil. I feel like there's a lot of negativity around Saudi Arabia's OPEC plus meeting a week and a half ago now. And I think that's over. I think the pricing in conversation is not part of the conversation as of right now. And Saudi Arabia is in the rearview mirror as of last week. And so, and then
I think oil bears needed Friday's unemployment report to not be what it was. If I was oil bear, I'd be
a real tough situation when you get into the mid 60s here, Chucky. There's just a tremendous amount of support in the mid 60s, both from an old resistance level to an old support level. There's a lot of pivot points. You got the 200-day moving average right there, and it doesn't mean it can't break, and it doesn't mean it can't go down to even 65 here.
And
but
here's the thing, man. Let's talk portfolio synergy. Let's say I'm a little early here. Well, my bond holdings
it doesn't mean you're wrong. You're early, but it doesn't mean you're wrong.
It doesn't mean I'm wrong.
You're right so far.
And basically everything else in my portfolio benefits from that chart going down. So there is some synergy with other plays, right?
One of the reasons why you own gold, by the way, is for the same reason. But the second reason,
that's my case. That's why I'm getting feisty on.
I like the case. I like the case. And I'll just take it one further from a technical perspective. The 200-day moving average was the entire reason why I anchored on oil here, 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 here. And for those of you listening to, those are all the pivot points between March and midsummer of this year. That was dealing with some extreme volatility, Mark. You had a couple times where oil was just absolutely catering, getting absolutely rocked, getting absolutely slaughtered, the end of the world type analysis, and 68 to 65 held. Now you're talking about that 200 weekly right around the $69 to $70 level, and it's starting to behave as a support level as well. And so that's always going to be one of those target zones. And I'm just wanting to do a PSA to President Biden here, because we're all good Americans.
Hey, go buy some oil, freak. Do it.
It's time to fill up the reserves here. It's time to fill up the reserves.
Knock it off. Buy.
You tapped into the reserves from an inflationary perspective. I'm not going to criticize that. We have reserves for a reason. That was a difficult inflationary environment, and you were dealing with Russia and Saudi Arabia that were trying to drive oil up. And so I'm not going to disagree with the decision to tap reserves in an environment where you could logically tap reserves to help your citizens, but that is not the environment now. And right now, I do believe the government has an obligation to make sure that we are secure from that perspective. And it's time to start filling the oil reserves, and don't try to get a lower number here. Just do it. Don't chase price when it's back up at 85. So that's what I'll say. But the government and you can create price. Me and Frankie, we're going to wait on a reversal here.
Yeah, no, and hopefully it provides. Hopefully, you know, we're talking 2.5 weeks from now on the halftime report. I'm like, oh my gosh, look at the great
W formation in 2 weeks from now would be salivating.
And that's when I'll get everybody screaming, because you'll have all of these other factors plus technical stability, which would be ideal.
Yeah. So. And standard, the shortest reversal you could see here is probably a week and a half. And that would be more bear stop out analysis. If you're looking for a traditional W, you're talking minimum 2 weeks from now. So it could be interesting in a V-shaped recovery, but I do think direction has a little bit of time.
Let's talk gold, man. I made my case for crude oil in the short term, right? Gold is not a short-term conversation. Gold is not a, oh, this is tact. I mean, that's what crude oil often is, man. It's a tactical opportunity situation, right? Oh, there's large disconnects, right? You and I never talk crude oil. Oh my gosh, crude oil is going to be at $200 one day because there's these fundamental drivers long-term, right? It's tactical. Gold is a different conversation, totally different conversation. And where crude oil can be very short term, we tend to talk gold long term. Mm-hmm. And Matt, I had 7 rambling, incoherent thoughts, maybe coherent, I don't know, on tactically buying oil in the short term. You have prepared 5 reasons to own gold, not tactically trade gold. Let's have a discussion.
And what I wanted to do in this discussion, Mark, is oftentimes when we talk gold, whether it's the podcast, halftime report, we're talking about it from a tactical perspective, right? Mm-hmm. We're talking about it from are you covered? Are you not covered? Are you adding? Are you not adding? What would be the pristine technical situation to add? But I just wanted to have just a brief conversation on the reasons why you own it in the first place. Not because I sometimes I get a little bit frustrated is not the right word, but I get a little bit annoyed when the conversations on gold constantly become about just the technical short-term conversation in gold. And the reasons I get a little bit annoyed with it is because gold should not be looked at as a short-term tradable instrument outside of day trading. Gold can be a wonderful day trading vehicle, but it is not a great swing trading vehicle. It is a great long-term investment. And the top 5 reasons why I wanted to talk about this is from a long-term investor perspective. When you look at the price charts right now, we're dealing with a lot of volatility in gold. I hated the V-shaped recovery from, not the V-shaped recovery, but I hated the algorithm response to the futures open last week. I thought it was absolutely ridiculous. The central bank started dumping gold a little bit to create a little bit of downward pressure in price. The dollar started going up as well based on the improving economic conversation. By the way, one of the reasons, I think you listed 7 reasons. I'll throw in an 8th. The dollar's showing a little bit of upward movement because of economic data. Well, if that economic data continues to improve, that will bring up oil. It would not bring up gold. It will actually bring down gold. But I do see gold in general, regardless of what happens with the volatility right now that we're going to have to traverse and navigate. I do see it as a instrument that is absolutely necessary to own in some capacity in your portfolio, whether that's digital gold with GLD or whether you're talking about a physical. And so I wanted to talk about the reasons why we own gold and the reasons why you should own gold if you don't own gold, because Mark, there's a lot of scenarios where we're talking about gold at 2,500 next year, where we're talking about gold eventually at 3K. And you know, those scenarios, if gold achieves 2,500 or 2,600 or 3K eventually, they're going to be backed on these 5 reasons, Mark. And so I wanted to talk about the reasons of why we own gold. Does that make sense?
Yep. Let's do it.
All right. So I'm going to go 5 to 1, and then we're going to talk about each individual one. Okay. Yep. Number five, geopolitical uncertainty. We'll talk about the detail here in a second. I'm just going to list them out. Number 5 is geopolitical uncertainty, and there is a tremendous amount of that right now. Number 4 is portfolio diversification. Remember what Coach Mark was saying about why he wanted to add oil right now, to give him a little bit of an asset class that would go against some of the other areas.
There's synergy.
There is some synergy there in portfolio design. Number 3, storage of value. Unlike currency, owning currency that has nothing but devaluation, gold has been a storage of values for about 3,000 years in the market, and that ain't going to change anytime soon. Number 2, currency devaluation. I'm not talking about your dollar devaluing. I'm talking about the entire value of fiat currencies in general. Mark, I'll talk about this in a second, but if you'll recall, I do not believe the dollar is going to die and another currency is going to replace it. I believe the fiat currency system will devolve into nothingness over time. I'm talking about the net value of every currency devaluing against physical asset classes, and gold is one of those big ones. And then number 1 is the inflationary hedge. And so, Chucky, thoughts on the list?
All right, let's start. And I will give you some brief general thoughts, and then you expand from there. Let's talk geopolitical.
Yeah, we're going to go down each one of these.
Yes.
As we go. It's just general thoughts on the list right now.
We live in a world, Russia-Ukraine war, the terrorist attacks on Israel, Chinese tensions. I do not believe geopolitical uncertainty. I don't think we're heading to the kumbaya period of peace over the next 10, 20 years. I think you're dealing with more, not less. That's my case.
All right, let's talk about those. Number 5, geopolitical uncertainty here, Mark. So Have you ever seen an environment where you and I are both students of history?
Yep.
Our father was a student of history. He really instilled that philosophy in us at a very young age. A lot of the historical conversations we would have with our father were about political history, war, World War II, World War I, what led into World War II. I know for me, I studied history back in college. It was one of my, it was my minor as I was going into law school. History was my minor. Political science was my major. I know your major and then your doctorate was in political science. This is a conversation we understand fairly well. I'm going to ask you very simply this, Mark. Since the Cold War ended in the late 80s, early 90s, when the Berlin Wall came down in that historical moment, have you ever seen a time, including the wars within the Middle East, that was more strife with geopolitical concern than we have today?
No, and one has to, you know me, I'll throw out all kinds of shit and see what sticks at the wall, right? I'm choosing my words very carefully here. We do not live in a world that is trending in the right direction.
No.
I just simply leave it at that.
The last time we had a conversation on the axis of evil, it was World War II. There's a lot of commonality between what is going on right now between 1918 and the 20s and the 30s that led into World War II. You got hot spots in the Middle East. You got the hot spots in Europe. Mark, the last time we had hot spots in Europe and the Middle East simultaneously was World War II. You have tanks rolling in Europe for the first time since World War II. You have Israel, in a war against Hamas right now with potentially expansion into Iran. You have Iran basically asking to get punched by the U.S., quite frankly. A little pot shot, cheap shot here in Africa, in the Middle East, in Israel, supporting terrorism across the board. You have China threatening invasions into the one China policy if the U.S. doesn't continually to support that. You have a true alliance in Iran, China, North Korea, and Russia. Many of that is based on commodity trade between gold and oil in the gold to oil pipeline between Moscow and Shanghai. You have, and that's not going to be broken in the short term. Where does all of this lead? Does Russia end in Ukraine? Does Iran get involved in the Middle East? Does China start poking the bear of Taiwan? And what is the U.S. response to that? There's a lot of variables here, Mark, but typically when you have this many variables, it doesn't get resolved in the most amazing positive way. And so I don't know what the future holds no more than anybody else does, but I'm going to tell you right now, I have tremendous amount of concern over the geopolitical uncertainty in our world right now. And I have more concern over the geopolitical uncertainty than at any point in my lifetime, because back when we were going through the Cold War last time, I was just a young lad. When the Berlin Wall fell last time, Mark, I think I was like, what, 12 years old? I remember the scenes because our father would talk to me about it. I remember the scenes because I was fascinated by it. I remember the pictures, but I was too young to remember the environment other than when I was 8 years old and we were doing a nuclear bomb test in elementary when we would get under our desk. And so it's really hard for me to look at a time in history outside of my life to say that outside of World War II, that was equal to the amount of uncertainty in our world today. And so however you want to categorize that, gold is often sought as that safe haven asset, Mark, in these times of uncertainty. Because and all of these reasons kind of they're not isolated. They all kind of lead to the one reason why you own gold. It's uncertainty in everything, whether you're talking geopolitical or whether you're talking inflation or whether you're talking currency devaluation or economic concern. It's all about that uncertainty, and that uncertainty sparks fear, not only in the investors and the traders, but it sparks fear in everybody, including central banks, which are hoarding gold at levels that we have never seen, quite frankly. And so geopolitical uncertainty, number 5 for me. Number 4, talk to me about this one, Chucky. Portfolio diversification. You talked about it with oil. I kind of feel it's the same thing here, that gold, many times in the market, somebody will tell me, well, I'm diversified because I have, Apple, Microsoft.
Yeah, it is the common man. When I have conversations with casual traders, like you run into someone at a party, you talk to someone at a social gathering, you're just, and talk, you know what they bring up SoFi and this stock and that stock and this stock and this.
And you're like, dude, come on.
Yeah, they're all stocks, right? Like it's like real
diversification we're talking about here.
Yeah, you have diversification with stocks, and oftentimes you don't even have that because you just all have the same type of stock, just with different ticker symbols, right?
Yeah.
Like I find my life as a manager of my own money, because that's what I do. I don't give my money to someone else. I manage my own.
You don't pay those fees to anybody else.
Oh, yeah, there's not a chance in hell I will ever pay a fee to someone. I can grow my money better than they can, and I don't have to pay anyone to do that. I find my life being so much better when I have a diversified group of asset classes.
That's the key word, not stock, asset classes. Continue.
Asset classes. It is why, and when I have that, yes, do we have moments where it is sell everything? Sure, right? Just owning a bunch of stocks not going to help you in that time either. But those times are very, very rare, and they're usually very, very short, right? Like think COVID. Did gold go down dramatically in COVID for a couple of days here and there? Sure, right?
Yeah.
You'll rebound all of it the next day, right? Type mentality, and certainly within a couple of weeks. I find my life better. Let me give you an example. I own a little bit of oil right now, right? I closed Friday at the all-time highs I've ever closed at in my Cash Flow Vikings trading journal. Most money it's ever had at the end of a Friday, even with oil bleeding some in a couple of weeks, right? Because everything else is doing well, right?
Yeah.
Everything else going well. And I promise you there will be stretches where oil is helping out other things.
That could be one of those stretches coming real soon.
Yeah, and so like it is, I just find my world to be a lot calmer and easier on a
2 a.m.
When I have some bonds and gold and silver or Bitcoin, and some of that I don't have at any given time, right?
No, you'll alternate.
Like I don't have any.
The one constant is gold.
Gold is a constant. I will have the cash flow exposure in gold forever for a lot of the reasons we've laid out. But portfolio diversification is so important and something that we should all spend more time thinking, discussing, and getting better at.
Yeah, I agree with that. Not much I can add to what you were saying. I would say that
it is the thing I probably am best at, Matt. Like out of all of the things,
you're top shelf at diversification in a portfolio.
Like portfolio management, diversification, building, maintaining. Yeah, it is just
you're better than I am at it. Like
it is something I really believe in, and
you will force a conversation in your portfolio once you hit certain metrics. Like you hit a rule in your portfolio and you had to convert some of that gold asset into GDX because it triggered too.
I won't go over certain. Yeah. I just want to go to bed every night, Matt, and think about other stuff. I think about the stock
mentality.
I think about the stock market 12 hours a day, sometimes 14. I don't want that to be it. Right? Before I'm going to bed, right? Diversification.
Gold and diversification amongst asset classes will allow you to sleep better at night. Number 3, storage of value, Mark. Storage of value to me, it's not just gold has maintained its storage of value for ever since it was first minted and used as a coin, but the storage of value is one that goes to the preservation of wealth. when you just have one asset class, you don't have a storage of value. When you have that asset class converted to currency, you have no value in and of itself. The value component of gold has never changed. The value component of dollars and currencies in a fiat currency system changes every second of every single day. The value you have today will vary over time. But in gold, gold has remained its value over centuries and centuries and centuries. And when you only own everything in dollars, you own everything in faith, not in value. And whether your faith manifests to reality or not is not part of the conversation. You want to store everything in a storage of value, and that maintains its value over time, regardless of economic systems, regardless of currency, regardless of the ever-changing condition of the currency market. What are your thoughts on the storage of value?
Yeah, no, I mean, this is something where, I mean, once again, like, not a lot to add, but like, not to pick on SoFi, but I just mentioned them. There's 1,000. In fact, let me not pick on SoFi. Let me pick on Lucid Motors.
Easier.
Lucid Motors, right? Probably will go bankrupt one day, right? Because most crappy companies do, right? Now, maybe it does, maybe it doesn't. We could have that debate. There will be companies that go bankrupt or values fluctuate, right? I don't have to worry about that. Right? Because Lucid Motors has a 2-year history. Gold has a span the century history. Right?
Yeah, gold's history goes back to the age of man, but it really goes back to, I'd say, I'd point it, the first gold coin usage was about 3,000 years ago. The first that was in a reserve status was about 2,500 years ago.
Why are central banks choosing gold as the instrument to add to? It's because this. It is because this.
Think about what you just said. It's why is gold the central bank's choice for the storage of value, which it is, even when the central banks are the authors and creators of the currency system. They could literally just print money and store it. Why do they just not do that? Well, because their money they print, they
need a backup plan, bro.
Values. Okay, that's number one. But also, the storage of value is not just here in the United States. Gold is recognized as a storage of value throughout the entire world. You can't say that about any currency in the world, including the United States dollar. And so storage value is a big one for me. Number two and number one kind of go hand in hand with one another, but I want to talk about the first one first. That is the currency devaluation. And once again, not necessarily just talking about the dollar, but when you look at the dollar over the last 100 years, we devalue against the current value about 1.8% per year, Chucky. And so regardless of what happens, inflation, regardless of what happens economically, regardless of what happens with your asset classes, everything you own will devalue over time when it is stored in currency. And so every single year, the United States dollar is going to devalue, and the purchasing power of that dollar will go down over time. Well, as dollars go down over time, gold is priced in dollars. And so as the currency goes down, the alternate, the pair, if you will go up. And so currency devaluation is a major reason, which is almost guaranteed. Don't get me wrong. The dollar trades against the euro. If the euro goes down, the currency known as the dollar will go up in value. Mark, that's how currencies are traded in pairs. The net value of its purchasing power declines over time, regardless of what happens between the two cross pairs. Think about it like this. If the dollar goes up against the euro, right? That allows Europeans to basically spend, their currency is a little bit cheaper. Well, both currencies' value in purchasing power still go down, despite the dollar going up specifically against the euro. Does that make sense?
Yeah, it sure does.
All currencies devalue. And what goes up in currency devaluation? the asset classes that are opposite, that would be, you could put crypto into that a little bit, Bitcoin into that a little bit, but gold is the one that everybody around the world understands. And so currency devaluation is almost a given in the market. Well, if you could almost guarantee currency devaluation, you shouldn't save money in currency. You should save money in commodities. And so one of the things that I did about 7 years ago now, Mark, is I was in a class and I was talking to people about this very same issue, about the dollar going down over time and what we can do as American citizens to protect against our own currency. And I talked to them about owning gold. But there's something psychologically up here, Chucky, for a lot of Americans, that they cannot overcome one really, 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 really strong mentality up here. And it's because they have to work for money. They make the number one mistake by associating the value of their money with the value of the time that they use to create the money. And so they have a very difficult time exchanging their money for gold, because they're thinking about how much value their time is. Their time has tremendous value. Dollars really, really don't. It's just a paper faith-based currency. And so I basically stated at the time, I asked everybody in the room. Now, mind you, this is a rich dad room. This is a Robert Kiyosaki room. I think Robert Kiyosaki has been preaching gold ownership for the last 50 years. This room loved gold. But even in that room, which had about 75 people in it, I asked them to raise their hands. How many of you own gold? And Mark, about 10% of the room owned gold. Now, these dudes and gals, they owned gold before they ever met me. And I asked the rest of the people, what's stopping you? And nobody could give me one reason. They all knew they needed to own gold. They all wanted to own gold, but they still could not get past that psychological hurdle that you have to overcome, because currency is just that. It's just money. It's not real. It is a creation out of the central bank that from the second it is printed does not have the same value that it was at the time it was printed. And every second after that, it is going to devalue. And it's going to devalue based on a lot of different reasons. But the number one reason it's going to devalue is also the number one reason why you own gold. And it's the reason everybody understands in America today, because everybody in America is dealing with it today. But it's happened for years and years and years, and that is inflation. The number one reason to own gold is to protect against inflation. And I am not talking about the CPI report going from 2% to 4%. I'm not even talking about the CPI report going from 2% to 9.5% like it did this year. I am talking about those situations throughout history, which there's over 100 examples in the last 100 years alone of currencies out of countries hyperinflating. And when you go through hyperinflation, the currency goes to zero, because inflation gets so far out of whack that the only cure to kill the inflation is to kill the underlying problem, and that's the money supply, which they kill the currency. And for those of you who are like, oh man, that would never happen in the US. Maybe not. I will say that in 1918, Germany basically was the number one economic system in the world. Germany was fighting a war against the entire rest of the world. Germany's currency was one of the number one currencies in the world. And 5 years later, the German mark to US dollar ratio went from 4-to-1 to 4.3 trillion to 1, to the point where the Weimar Republic had to kill the currency and issue a new currency. And because banks and countries are so creative, they named it the Mark II. So they killed the German mark, then they issued a Mark II. That one later died, and you'll be like, well, that was the Weimar Republic. Well, what about China in the 50s? What about Brazil in the 90s? And all these other countries that have went through it. And if you say, well, that's not the US, well, what about Britain when they lost reserve status, and what happened to the British pound, or any other historical example? Everybody always believes that this time's different. When you're dealing with currency, when you're dealing with inflation, when you're dealing with these conversations, it's not different. That's why gold has been the number one hedge against inflation, the number one storage of value, not in the last 10 to 20 years, which that in and of itself is great, but over the last freaking 2,500 years. And so with that context, that's my list. Number one, the hedge against inflation. What's your thoughts?
Well, you left off the most important thing is like, I like to give the middle finger to central banks and fiat. And that's why whenever I do anything in gold or Bitcoin, it makes me feel good as a human being. Right. But I don't know how you argue it against a sensible argument, and individuals will say blah, 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 right? There's some people that just hate gold because I don't know why, right? It's just a sensible top 5 list. It is just a sensible reason. You do not have to be crazy from a cash flow perspective. Holy cow. Gold's amazing, right? It's just being responsible with it like you would anything. But there is just a case to be made to take this corner of your portfolio, whatever that is, you can decide percentage and say, yeah, gold, not SoFi, not Apple, not iron ore, not this, right? Say, this is my gold and this is how I'm going to manage it. And from an investing long-term perspective, I don't know how it doesn't exist in your portfolio, right? From a cash flow perspective, it's fantastic.
I've coached and mentored for a long time, Chucky, and I've taught thousands of people. And at no point have I ever not designed a portion of a portfolio that has some degree of gold ownership in it. It's just, and I think you can say a little bit of the same thing for oil, right? I'm not sure you can say the same thing for other commodities. I don't think you go into a portfolio design saying, I need to design X percent in copper or X percent in silver or X percent in any of the other metals and mining classes. But I do think you say that about oil, and I do think you say that about gold.
No, it's it just fits.
Yeah.
It just fits.
Like a glove. Well, Chucky, that's the top 5 reasons to own gold.
Well, that's been a very enjoyable podcast. Very much enjoyed participating. Hey, last one, Matt, we got some fun ones coming up. We'll have some fun. We'll prepare for them, but it'll be a different level of preparation, right? And so, but that does not mean you cannot find Matt and I's current thoughts on the halftime report at Tackle Trading. Every day the market is open. And let's close out, Matt, by talking about the fantastic covered calls webinar coming up. And I know on gold products, they make fantastic covered call instruments. But talk about it.
Yeah, if you're not familiar with the Tackle 25, there's actually 4 lists that go along with the Tackle 25. You got the Tackle 25, which is our fundamental list that we love doing covered calls on for both retirement accounts, margin accounts. You also have the Dirty Sexy Money list, which is probably a little bit more popular than the actual Tackle 25 because it's got a growth component to it, and our community loves naked puts and boomerang trades, and that DSM list is perfect for that. Poor Boys covered call list, top 10 stocks for that purpose, and then you got dividend fireworks. I'm going to talk about it all on that December 19th webinar. So I'll save that for then. Why don't you just go and you can find the link to register for the December 19th webinar on our Tackle Trading website. There's a banner at the very top. You can click that banner, and all you have to do is register and just come hang out with us on the 19th. And I think you're going to really, really enjoy what we do with the Tackle 25. And if there's a lot of reasons why you do covered calls. One of the reasons, mitigate downward pressure in price. And the other one is to create a consistent cash flow, which will offset volatility. If you want a reduction of volatility and more money, come register for the December 19th Tackle 25 webinar. We'll show you how to do it.
Yeah, absolutely. Listen, looking forward to discussing covered calls. Covered calls are amazing. They're just absolutely amazing. But I have a feeling that we're gonna have a fun time closing out this year.
It's always fun.
All right, listen, it's been a fantastic. Check us out next week on our year in review. But you can catch us throughout the week on the Halftime Report and then through all of our tackle trading products. So have a wonderful week, everyone.